Today's session will be with Cyril Demaria, who will share with us a macro update and his insights on secondaries and co-investments. Cyril is a renowned PE expert combining academic expertise and practical experience thanks to his different positions. He is also a partner at Valorsoft & Partners, an independent CIO service provider for family offices and financial institutions, where he heads the private markets research activity. Cyril is an active lecturer in top academic institutions and also the author of best-selling books like Introduction to Private Equity or PE Fund Investments, which you certainly have heard of or reads each night. Each separate module of today's training will have a short Q&A session at the end. Please use therefore the chat button and ask your question. A short break of a few minutes between each module has also been planned. This training will be recorded and made available for a limited period of time. To make it as comfortable as possible for everybody, please mute yourself during the different modules and explanations. So without further ado, please welcome Cyril and let us start this great training.
Thank you very much, Stefan. That was very comprehensive. So actually we saved a lot of time. Hello, everyone. Since my background is not particularly appealing and I assume that my fancy haircut would need a refresh, then I suggest that we switch immediately to my slides and we start to dig in. So normally you should see my slides. As Stefan kindly said, we will have a regular Q&A session. So what I suggest is that I go through the different modules. You will see that there are 3. And the first one is a little bit shorter. It's around half an hour. And then we do the Q&A. It's a little bit easier to manage for me. And notably, some of the developments might answer some of the questions you might have. To wrap up, let's say in a title, the full session today, I would use the term tactical asset allocation, because usually when people ask me to talk about macro and then about secondary and co-investment, there is this implicit logic that they want to understand where we are and then they want to act upon it. And in private market, actually adjusting asset allocation is not that easy. And so the logic of combining the macro with the secondaries and the co-investments, which are the 3 modules, is actually a good way to bundle it together with tactical asset allocation. And that's how I entitled this masterclass. Let me. Does it work? Yes. So that's me. So Stefan made the introduction, and I think we can skip this part to save a little bit of time and have more for the Q&A. Maybe as a sentence to launch this presentation, I would quote, and that sounds very far-fetched, but you will see that there is a connection. Heraclitus. Heraclitus famously have said, at least that's what we heard, that nobody ever bathes in the same river, right? And I would say that the purpose of this first module is to say the same in terms of private markets. And it's not only about the fact that macro conditions are changing, but also that private markets are changing. And that's why it's so difficult to come up with a definitive answer to what are going to be the consequences of the current crisis, because that's what I think is interesting for any one of us. But it's also very important to put this in perspective, to try to find what could happen and what we know so far, but also understand what we don't know and what are the limits of our understanding. So let me start up with this. So that's setting the scene. This is no groundbreaking, but there are few consequences of this slide. So we know that there are 3 elements in private markets which are very, very important. The first thing is that it takes very much time to deploy the capital, and the programs are usually set for 5 to 7 years. Now, this is very important because it means that when the crisis struck, it's very unlikely that someone was launching a program or finishing a program. Most of us are in the middle of it. And actually, when we're at cruise speed, the programs are self-renewed. So every year we commit to new funds. Every year we are expecting a certain number of distributions, a certain number of capital calls. And this is the standard format. Now, what's very interesting is that when we assume this, we project, for example, distributions, we project capital calls, but of course the crisis is going to disrupt that. So what we're going to have to factor in when we're going to analyze in a few minutes what are some of the consequences of the current pandemic is how it will affect, for example, the capital calls and the distributions. And we're going to come back with the credit lines, for example. The second aspect, which is extremely important, is that net asset values lag the evolution of listed assets. And we know that, and I will show you a graph on that, because first of all, fund managers have to report after the end of the quarter or the semester or the year. And also when they reflect on the net asset values, they don't reflect on the latest developments. They reflect on a certain time and certain time frame. It can be the last 3 months, but usually it's over the last 6 or the last 9 months. So even when we will get the figures as of end of March, which are not available yet, we will not see the dramatic changes that we've been witnessing on the stock exchange, and I will come back to that. Nevertheless, this has consequences. The consequences is that the lagging of net asset values on the listed assets is that when you have a very benign environment, which was the case until the end of last year, over the last 10 to 11 years, then you have a kind of numerator effect. So your target private market exposure is always too small compared to the fact that actually your growth of other assets is faster and bigger, notably listed stocks. So if you allocate as a percentage of your total asset base, then your private market allocation always look too small. So you're running after your allocation. And then when you have a sudden and sharp correction, as we saw, for example, early this year in developed markets, then you have the famous denominator effect. And we're going to look into that and to see how, for example, investors handle that. How did they learn from the last financial crisis? Another thing that we're going to see is that the net asset values, the way we evaluate them, has been changing over time. So when I was quoting Heraclitus saying that we never bath in the same river, it's not only that the river is changing, but also that you as a bather, you've been changing as well. You're not the same person. And in 1 hour, you won't be the same person, hopefully a little bit more informed about macro and private markets. The last thing which is very important is that regardless what we say, private markets are still not an organized market. We're going to come back to that in the secondary aspect of this 2 hours session. But most of the transactions are still at arm's length, and it's very difficult to rebalance portfolios. So if you assume that you have a kind of denominator effect, the question is, what can you do? Can you really get out, or can you rebalance? Can you do something about it? And it's actually very, very difficult to do that. The only two instruments we have are the ones we're going to look at today. That's co-investment and secondaries. You probably see this graph on the right side. I think my pointer should be visible to you. Maybe I can highlight or laser, whatever. Here you see that actually the curve here is the secondaries curve, right? It's a very interesting one, because when usually we talk about secondaries, we talk about upfront, let's say, exposure. And then we talk about capital at work, which is faster. But if you look at that, actually the maximum exposure here in this theoretical example, but which is based on actual figures from Prequin, is that the maximum exposure is around 42%, right? If you look at the other strategies here, they go much, much deeper. So it's something we will come back to later. I put the graph here just to signal it, but hopefully you will remember that when I will refer to it later. So let's have a quick look at how private market changed, because I think you want to jump more into the macro, but just so that we're all clear about it. I split it into midterm changes in the past and short-term changes as well. The first thing which is very important is that it's not a cottage industry. I have a full slide on that. I will highlight 2 or 3 very key figures that maybe some of us overlooked or don't always remember. So I would like to spend like 2 seconds on that. The second thing which has changed a lot is that it used to be 1/3 insurance money, 1/3 bank money, 1/3 pension money. And now pension represents still around 35 to 40%. But insurance groups are down to 10 and banks around 6 to 10% of the sources of capital. This has consequences on the industry, notably on the secondary market, because the reason to sell or to buy on this market are changing with the nature of the sources of capital. And sovereign wealth funds are increasingly a major source of capital. They represent now around 10%. And there are, of course, family offices, which have been growing. But I would say there is a scattered source of capital and one anchor, which is the pension funds. The third element, which is extremely important, is that it used to be that in terms of exit, the sources of capital, and that's very important when you think about distribution in a stressed environment. The sources of capital would be trade sale, which are usually slowed down because people are scared. The referentials for pricing are a little bit more challenging to set up. And then you would have IPOs, and a very distant third would be secondary buyouts. And now we know that secondary buyout represent 1/3 of the deal activity. So what does it mean? It means that the buyers and the sellers on this market are professional and they have capital and they are not particularly scared. The only thing that they're waiting is for a stable referential to set up a price for the assets. But that also means that if you count on distribution, as soon as the dust is going to settle, you will have a resumption of the deal activity. And that's something which is fairly new. That's fairly new. I mean, secondary buyouts used to be a very distant exit scenario. Now that's the second most popular, very far ahead of IPOs. For example, we don't count on IPOs anymore. That's not such a big deal. Secondary buyouts or secondary transactions, so GP to GP, are actually a very major source of deal activity. And that's very important. The fourth element is that portfolios are now marked to market. That sounds obvious, but interestingly enough, we started that just at the moment of the last crisis. So we never have experienced a full cycle with portfolios marked to market. Admittedly, that's mostly buyout, a bit of growth capital and mezzanine, but venture, there is no real mark to market, and distressed debt, of course, is not necessarily mark to market because that's very challenging to do. Nevertheless, it's important because if we think about denominator effect, it used to be a much more important factor because the portfolios would be very sticky. Now, since they are mark to market, we're still importing some of the movement in our portfolio, which is coming from the stock exchange. So actually, the denominator might not be a problem anymore. What could be a problem going forward, especially for pension funds here, is that the portfolio will look much more volatile. And for a lot of regulators, volatility means risk. We used to be the good pupil sitting in the front row in front of the teacher saying, I'm not volatile, I'm very stable, I deliver on my promise, I'm always very conservative. And now we're a little bit more on the middle of the class, rioting with the rest of the class, you know, and making funky stuff. And then the teacher is looking at us in a very strange way, like, ooh, they're much more volatile than they used to be. Maybe they're more risky. And I think that's going to change a lot of things. So here I put some figures about asset allocation, and that's related to the cottage industry. It also means that rebalancing remains still very difficult despite this evolution, and I think that's very important. So let's move quickly to the next slide. This slide is something you know very well. I won't comment a lot of it, but I did a few quick ratios, as you can see on the right. Everybody's scared about the dry powder. I'm not. I'm not, because 1/3 of this dry powder will be used to recycle the assets which are currently in portfolio. For that reason, I don't necessarily get particularly scared, and I think it's healthy since the asset class is growing, but you collect always more capital to buy more assets. So what worries me more is the fact that if you look at this light blue bar, so it's very stable here, and then we start to change the regulations in 2006-07. We switch to the mark-to-market. There is a slight decrease from 836 billion worth of assets in portfolio to 742. But if you remember, the stock prices crashed by around 40 to 50% at that time. So that's not necessarily reflective here. And then we have this massive ramp up here. And that's on the back of the implementation, of course, of the mark-to-market, but also, of course, the portfolio buildup. It's like more fund managers, bigger funds, more assets acquired, etc. The problem is that since we never really experienced fully what happened in 2007, 8, and 9, now the big question is how will it look like when we had, I didn't have the figures for 2019, unfortunately, but for 2020 and possibly 21. And that's the big question mark, the big impact of the correction on the value of the assets. Now, if we move to short-term evolutions, first, we saw a massive evolution of the secondary market. Last year, it's supposed to have been a transaction value, total transaction values should have been amounted to 88 billion, which is around 10% of what was raised by funds for the primary market. So it's still fairly small, contrary to what we would think, even though it's been growing very fast, and we will come back to that. I will have a slide. The second thing which is interesting is the use of credit lines, and actually nobody knows what's the total exposure. Every time I ask the question, there are a lot of educated guesses, and actually nobody really knows, and that's actually something which is very important because there might be a risk here. Maybe it's an important one, maybe it's not. The optimists say, well, credit lines are backed by AAA pension funds who will always pay. That's one way to see it. Others are like, well, if we cut just the credit line from one day to the other, there will be a massive scrambling for capital calls. And then you will have this wave coming the way of the LPs, and they won't be able to face it. So that's going to create a lot of troubles for the industry. So far, we never heard anything, but we're just at the beginning of this unfolding. And then the question is how the risk is going to be overall when we are going to look at these credit lines. The third element is that there is a widespread use of covenant-light loans, and that's something we're going to come back to when we're going to look at the impact of the coronavirus. The covenant-light loans, here again, you will have the optimist who will tell you that's great because it gives you a runway. So if you have an issue like we had recently with closure of businesses, temporary closure of businesses, then you won't hit your covenants too fast. You might be able to handle it. I don't know if it's totally true, to be honest. It depends also on which industry you're in. The other ones, which are more pessimistic, would tell you that's worse because it delays the moment of truth, which is the bankruptcy. And so when these companies are going to end up in bankruptcy, maybe it's beyond salvaging, and then we will have a massive wave of liquidations. One of the things which is very important, though, to keep in mind is that the equity contributions, notably when we talk about leverage buyouts, are higher than 2007. That's related to the guidances of the US regulators and the European regulators who say, if you want to borrow more than 6 times EBITDA, you have to have a very good reason. Of course, we know, and it's been reported that EBITDA has been more creative recently. That's a fact. But nevertheless, if you really look at the contribution of funds, they tend to stick to this 6 times EBITDA, even though, as I said, EBITDA might be creatively assessed. So it's a little bit an in-between. It's less worrying probably than before the last crisis. The last thing that we know from the last crisis, and I wanted to highlight this, even though it's not a short-term evolution, but just as a reminder, is that actually, during the last crisis, the investments of the funds, that's been documented by academic literature, did better than the rest of the economy. And notably, that's a very emblematic case, but Blackstone, for example, decided to reinvest in Hilton, and a lot of other funds apparently decided to do so. So it means that fund managers are actually fairly, let's say, resilient in that. So what are the potential consequences of the short term? First of all, we might have, if we look at the past, a nuclear winter for VC. That's what happened after 2001. I mean, 2001, there was a long time where VC was very, very not favored. The second thing is that we might have market distortions due to the new quantitative easing and a kind of Japanization of the economy where you have a lot of zombies, and that's actually bad news for distressed debt and non-performing loan investors. And then there might be a reset of the value of collateral, because we know that, for example, today commercial real estate, but also hotels might be much more valuable, much more difficult to value than it used to be. So what do we actually know from the macro side? We know that there was a sharp drop and a recovery. I will show you the graph in a second. You probably saw it, so I will not go very long on that. And currently, the stock prices are propped up by the motto, which is there is no alternative, right? The second thing that we know is that there will be a significant drop, at least in developed markets, of the GDP over the course of the first semester of this year. We don't know after that. Everybody has his own theory, but actually nobody knows. The third thing that we know is that some sectors are heavily affected. I name a few here. It's no surprise for you. And others are, at least on paper, positively affected. So we can assess some of the consequences. This graph is probably something you saw. The reason I show it is just to point out, so there is this very heavy drop here. And if you look, it's around 30%. And then there is this recovery, right? So does it ring a bell? Well, probably yes. Let's have a look at 2008. If you look at the drops, okay, cumulatively, they were much higher, right? But if you look at the evolution, for example, of this quarter, where you have this heavy drop, then you will see that the indexes correct significantly. And in most of the cases, the NAVs actually didn't change. Then there was a moment of truth. That's true. And you realize that it's when it's audited at your end, but the NAV corrected. And then after that, the fund managers were fairly conservative, and they were conservative on the downside. And when you were talking, as I did, to them at that time, they would say, well, actually, my companies didn't do so bad, notably because here you had a lot of bank and financial institution in these indexes, whereas in the portfolio of fund managers, you don't have such, let's say, representative of industries. So they didn't have to correct that much. And that's also something we need to keep in mind. It's like the nature of the indexes tend to diverge from the portfolio of the European and the American LBO players. And also on the upside, as you can see, they didn't materialize that much, admittedly much more than on the downside, but still they tend to be fairly conservative. And actually it's a constant. It's been documented by academic literature. The best fund managers and the better they are, the more conservative they are in applying the mark-to-market. So we shouldn't expect such massive changes of NAVs, especially if we have a one-off correction with a very V-shaped format on the stock exchange. I'm not talking about GDP here, only pure market phenomenon. So I know that the journalists are after that, and if actually the NAVs, when we will see them at the end of March, don't correct that much, they are going to blame the fund managers again, saying that they're fudging the results, etc. That's not totally true. Actually, it might not be true at all. It's just that they are very conservative, and if you have a V shape on the stock exchange and you look at the past over the last 6 to 9 months to value your portfolio, you don't necessarily to reflect the full brunt of the correction of the stock exchange. And notably, once again, because the indexes are reflective on industries that might not be represented in your portfolios, okay? The other thing that I usually get as a question, and I was very interested to see this graph, is, okay, there will still be some consequences on the funds that I have in my portfolio. And so how is it going to look like? Well, here you have the different vintage years, and then we looked at how did they move in terms of TVPI along the time, and notably when we had this massive correction on the stock exchange here. And actually, if you really look at it, you will see that actually 2005 and 2007, so 2005 is this orangey curve here, okay? And then you have 2007, which is the light green, okay? These are the ones which suffered the most. But there are two messages here, which I think are very important to keep in mind. The first one is that they still recovered fairly well, and actually they ended up with a multiple, net multiple on aggregate, which is around 1.5. The other thing is that the one in the middle, 2006, which you would expect would suffer as much, did actually pretty well. This is the dark green here. It goes very, very deep. Then it rebounds and it ends up actually above 1.7. So it's not because you would, look back and say, oh, 2006, 17 and 18 are going to suffer, but the most likely candidate, if we assume that's a big assumption, that we replicate what happened in 2008, 2009, these would be the three which are going to suffer, right? But actually, it's not necessarily true, because we see that 2006 did fairly well, which of course triggers the question, how is that even possible? It's because in the sample, you have different fund managers, and fund managers react very differently to market conditions. So you might end up with 2006 where the fund managers were particularly good. And in 2005 and 7, you didn't have such very strong performers. And we know that fund managers raise funds every 2 to 3 years. So you might end up 1 year with very, very good fund managers in one vintage, and the next year they're not represented anymore. So it's very important to keep this in mind, because otherwise we tend to make parallels and to get scared, or to make too many parallels which are scaring us too fast. And here the cautionary tale is the 2006 versus the 2005 and 7. But interestingly enough, you will also see that the ones who started during the crisis or just before, because they're in their investment period, actually did very, very well. Look at 2009, right? And 2008. I mean, these are, of course, the vintages which did very well, and that's no surprise. It's been documented very regularly that vintage years which started just before a crisis or during a crisis perform extremely well. That's notably related to the fact that the assets are priced much more attractively, and also that the fund managers buying them have a very clear idea of what they're going to do. Just checking the time to make sure that I'm still on track. Actually, I should hurry up because I'm already 30 minutes in. So what are the things that we don't know? The first thing is the GDP evolution. Here you have a graph from the Wall Street Journal repeating what the Fed said. I think it was 2 days ago. And the question is, what are going to be the shape of the recession and the recoveries? This is 2008 and 9. And this is, for example, 80 with a double dip, which apparently was very, very challenging to handle. And this is, of course, what happened in the 30s. So we don't know that. And of course, the level of sovereign debt, the level of inequalities and employment, etc., is going to change a lot of things. We might even have a double or triple dip on the stock exchange. As we saw with what happened earlier on the graph in 2008 and 9, we saw that there was 1 quarter significant reduction of the stock prices, next quarter small reduction, and then another one very, very big. So that's also possible. So the conclusion is that each crisis is unique. So one of the things I still want to highlight, because that's also something which unfortunately a lot of especially on the media side are not aware of, is that if you really look at the risks, because when we look at the macro, it's about performance, but it's also about the risk, right? It's actually, you don't lose money. And that's something which for me is very important. If you could buy the market, you would never have lost money, for example, in European buyout. And that's very, very telling, right? Of course, it's very unusual that you get this 3.25 times your money, like in 94, but that was just in the middle of the Gulf War. So that's possible, but it's very unusual. But if you look at it, you're oscillating between, let's say, 1.5 and 2 times your money. And the other thing, because usually people say, oh yeah, but it's because of the top quartile, and if I don't get access to it, I would lose money. Actually, if you look at the bottom graph, the only time you could lose money with the bottom quartile, so below 1 time your money, is actually in 99 and 2000. There might be here a 198 in 2007. But actually, to lose money, you have to put your money in the bottom 5%. So that's very important to keep in mind, because when we want to step back and to put the macro perspective in a broader context, it's very important to keep this in mind. Of course, you cannot buy the market and you will have to select funds. But even if you select the bottom 25, it's not necessarily the case that you're going to lose money. And as I said, it's possible that actually some here have been on, let's say, the unlucky side. So they got some fund managers which were not performing, but on a constant basis, it's very difficult to lose money even with the bottom quartile. Another perspective, and then I will try to wrap up and go into the Q&A, is this. What I did is that I said, okay, if I'm an investor and I want to look at how often do I lose money if I apply a regular program which diversifies across vintage years, across fund managers, and across some geographical areas, then I should look at how do fund of funds behave, right? And fund of funds, of course, are expensive. There are fees and carried interest. But if you look at it, how often do they lose money? You will see that in total capitalization, it's very, very small. In number of funds, it's a little bit higher, but actually most of the time you're actually making money. And there is no, let's say, survivorship bias, because that's usually a question I get, like in hedge funds, they have the survivorship bias here. No, Cambridge actually tracks, and regardless if it's a good or a bad outcome, they don't scrap it from their database. So when one of their clients is in this fund of fund, it stays until the end, and it will remain so even though the fund of fund is fully liquidated. And I think that's also very important, this distribution of performance, because you see that, yes, you have this normal distribution, this bell curve, right? This Gaussian curve, but it's skewed. So there is a skewness towards the right, and that's what you want. Not only you're sitting in the profit side here, but also you have this very nice fat tail on the right, even though it's not very even, but it's also showing you that if you do a standard program, you shouldn't get too worried by such an event as we're witnessing at the moment. It doesn't still solve your issue with the other assets besides your private market allocation, and that's why we have a module on secondaries and co-investments. But the program itself, if it's well done and well diversified, you should end up with some sort of format here. Whether you're in the 0 to 10 or 10 to 20, of course, is very important to you, and I understand that. But if you assume that you want to assess your value at risk, so basically, really these losses on your program, you see that actually the chances are fairly small. So what are the consequences? The first thing is that for fund investors, there might be a slowdown. Some are already in wait and see. But they learned their lesson from 2007 and 2009, so it's very unlikely that there will be fire sale unless they're really forced to do it by a double dip or very, very strong cash requirements. The other thing is that even if they reduce their exposure, there are alternatives. Earlier, I said the secondary market has been growing. It has been extremely innovative, notably by the emergence of preferred equity, which means that you don't have to sell on the secondary market. You can ask someone to pay for your capital call and to split the performance. Another thing which is very important is that the mark-to-market is still new. So some fund investors might have their own opinion on let's say, the valuation of the fund managers. So there might be a kind of new system which is set up where you can recompute, for example, your exposure as a fund investor and take some distance from what the fund managers tell you. What are the consequences for fund managers? Potentially new deals in buyout and distressed debt, with all the limits associated to what I said about the zombies earlier and the covenant light and all the other elements associated with this quantitative easing. The interest rates are going to remain low, but the question is, are we still going to get leverage loans when we want to do large and mega buyouts? It's not only a matter of rates, but it's about where does the money go? And VC valuations might be more attractive. We have to be very careful. Usually they're very good at communicating when they're up rounds. When there are down rounds, you would be very surprised to see that actually we will hear far less about it. And remember that the valuations in VC anyway are to take with a lot of caution because of the preferred rights and all of that. So is tactical asset allocation relevant in private markets? That's what we're going to look at. But there's some elements we need to keep in mind, in particular, not timing the market. So what we will do after the Q&A and the first mini break is to look at what is the use of secondaries and co-investments and what are the things to keep in mind, okay? I will skip this part because we're going to look into it. Do you have any questions for me?
Yes, Cyril, I have 2 questions.
Sure.
I don't understand the concept of that the PE is now mark to market. It's not really.
according to European and actually accounting rules, the net asset values have to be, and you have to prove to your auditors and the third-party evaluators under IFMD that your portfolios are somehow reflective of the evolution of the peer group. The international private equity and venture capital guidelines are providing a series of methods that you can apply, and the comparable method is actually the one which is the highest in terms of level of recommendation to evaluate your portfolio on a regular basis. But you're right in the sense that fund managers still have a lot of discretion and they tend to be very conservative.
Okay, so mark to market in the sense of not public markets, but IPEV guidelines.
Correct, yes. Yeah, I wasn't precise. Yeah, that's true, yes.
Okay, and another question is about the J-curve effect with secondaries.
Yep.
I mean, I was at the LP conference of Color Capital.
Mm-hmm.
They say in 30 years of all strategies, secondary funds that lost money for their investors were 1% of funds versus much higher percentages for other strategies. Do you think it's going to be the same this time around?
That's a challenging one. There are two elements which have changed. The first one is the level of discounts. And these are public statistics that I'm going to comment in after our little break. But the level of discounts have been decreasing a lot. And in particular, it used to be around, let's say, 20 to 30%, and now we're around 5 to 10. So it means that you could have a kind of absorption shock cushion, if you wish, but you don't really have anymore. The second is that as the NAVs are more reflective of the evolution of the price of listed assets, it means that not only you don't have the discount anymore, but the NAV is a little bit less conservative. So ultimately, maybe color will, remain as good as they used to be, because we have the expertise and probably a lot of know-how that we can mobilize. If you're doing a random investment in secondaries, you might not have the same, let's say, favorable wins than you used to do. And these are the discount and the conservative NAVs that I was referring to. So I'm not sure you will lose money, but the question is, will you still perform very well, especially given the fact that the most prestigious funds are actually trading at a premium on NAV, and the fact that there is a lot of money on the secondary market. So the competition means that even in a downturn, the assets might not decrease in value that fast, or it might be a very difficult play. You might have to face, for example, an emerging fund manager or a very niche fund, or in an emerging market. These are the very difficult plays. You might make a very nice investment, but also you need let's say, the expertise to assess that very fast. Let's move on then to, if it works, secondaries. Secondaries is something we studied quite a lot. The reason why we studied it is because we had a client once who said that they ditched completely their primary program to move purely to secondaries. And when we started to discuss with them about their motivation, they said, oh, well, basically it's control. We know what we're buying. It's capital deployment. It's faster. And ultimately, it's also better performance. And when I heard that, I thought that makes sense to a certain extent. But immediately, my little voice said, well, if it was this, it's almost too good to be true. So we started to look into it, and I will try to provide you with some hard facts. Just for full disclosure, I presented this in another format in a conference which was dedicated to secondaries, and the players were very, very upset. So don't be upset if the conclusions sound a little bit more critical than what you hear about secondaries. So what are the benefits of secondary investments? Theoretically, it's a combination of 6 different factors. First of all, there is a discount on NAVs. If the NAVs are conservative and you have a discount on it, that gives you, of course, a kind of head start in terms of performance. The second is that to a certain extent, you know what's in the fund. It's less true if you do primary secondaries, so funds which are fairly young, like 2 to 3 to 4 years old. There is still some sort of runway in terms of capital to deploy. But still, you have a fairly good idea of what's already in the portfolio. You could forge an opinion, at least, okay? The third is that theoretically, because there is this capital deployed, then of course, if you're subject to negative or low interest rate, then buying on the secondary market is a good way to park your cash, right? And of course, your exposure, your duration is shorter. That's also one of the positive aspects to secondaries, which somehow contradict the first one, because yes, you can deploy capital faster, but if you get it back faster as well, it might not be that great because then you need to find more, right? So it's like, it's almost running against your shadow in a way. The fourth element is that you can learn. And to a certain extent, it's true. In particular, if you have an emerging manager, a fund 1 or fund 2, if you're buying on the secondary market, you might see already what they invested in. So it's less of let's say a gamble than when you actually start from scratch. Even though if you support emerging managers, usually you have an insider or at least an informational advantage. But nevertheless, that's a good way to learn about the manager and to get access to it to some extent as well, if it's a heavily subscribed fund. Then there is a diversification potential. I will come back to all these elements. That's on paper, I'm listing the arguments. And then you have an attractive performance, at least in terms of IRR. Now, let's have a quick look in practice. The first thing which I want to highlight is that the secondary market is a very, very strange market. Normally, if you look at the figures from the LPEA, the Invest Europe, and a lot of associations, and they show you the activity of a market, they will show you that the blue bars, which are the capital raised, is systematically higher than the red bars, which is the capital effectively invested. The reason for that is that the difference between the excess of blue versus red is the cost, management fees, and all of that. The secondary market is a very, very weird market because that's a market where generally you have an excess of transaction versus capital raised. Why? Because you have a lot of co-investments. You have a lot of investors investing out of their balance sheet. So that's what we call somehow shadow capital. And that explains why you have these discrepancies. And so that's very important because when you look at the dry powder and the capital raise and you try to understand the logic and the dynamics of the market, you have always this hidden part of the universe. It's like the dark matter, right? We know that it somehow exists, or we assume that it exists, but nobody has ever seen it because it's dark, right? And here it's the same. And so whenever we talk about secondary markets, it's very, very challenging to know what is effectively happening. When I did this study, I talked to different intermediaries and I asked them, for example, how many deals there were on offer and how much were actually transacted. And they said, we had 3 times more on offer than what effectively was transacted. Okay, so when you hear about 88 billion transacted on last year, the number of transactions, which I don't know how many does it represent, there were probably 3 times more elements for sale, but for some reason they didn't find a taker or the transaction never happened. That's also something which is very important to keep in mind, especially in terms of market dynamics. According to Triago, and these are figures as of April this year, there are around 140 billion of actually dry powder, and that includes the shadow capital according to them. Whereas if you look at the figures of dry powder versus, for example, the average last 3 years of transaction, it represents around 2 years. And the investment period of secondary funds are much shorter than the ones on primary. So you see that actually there is a fair amount of capital. It reduced. It used to be 2.5 years when I did the first version of this study in 2017. As of end of last year, it was down to almost 2 years. But there is still a strong competition, which are, of course, having an influence on the prices. And this is this slide. This slide, I think, is very interesting because it shows, of course, the discount versus premium. Now, of course, if you look, you would say, well, you know, 2006-07, we were at 108, 104% of NAV, right? But remember, most of the portfolios were not marked to market. The fair market actually value has been applied after that. And so the referential on which you compute these discounts or premiums is slightly different. So that's very important because it means that, as I said, you don't necessarily have as much as a headway as you used to have before. So there is no real good surprise. The other thing is that the question that we usually have to handle is, what does the discount represent? And the discount is actually negotiated by the buyer on the secondary market to compensate for a lack and significant asymmetry of information. And I think it's very important because today, when you say that you have a discount of 5 to 10%, then it means that either the buyers are more sophisticated, they have more information, that's possible in fund of funds, or very, very sophisticated LPs, or it means that you have basically a transfer of risk from the seller to the buyer. So you need to compensate. The discount is not just something that you negotiate because you're a very good buyer and you have very strong bargaining power. The discount was a recognition of the fact that you as a buyer, you're buying something which you don't really know in a very short time frame and with a very significant asymmetry of information, as I said. And this has changed. And this is reflected in these figures here, okay? Not too fast. Oh no, that's good. So what do we really see? So when I did the study, I talked to the intermediaries and they said, well, most of people approaching us, they want to buy the ideal fund, right? Should be fund 4 or 5, shouldn't be too old, should be with the best fund manager. They even have a list. They should have this discount, which doesn't exist anymore, and they want to have 2 to 3 months to make their study. And they said, today, that doesn't exist anymore. At best, you have 30 days. There is barely any information, even less than before. Usually you cannot even talk to the underlying assets. You cannot really get detailed analysis done because basically what you get is the last 2 to 3 quarterly reports, and they might be more or less detailed. And what is also very new is that the market started to structure. It's not about the growth of the market, as you could see, in terms of volume of transaction. It's about the fact that the technicity and the professionalism of the different actors has been increasing dramatically. And now you start to have these 4 levels of asset sizes. So you have large blocks, that's where Ardian, Harbour West, and Lexington are. There is barely any competition there. And I would almost make a kind of parallel with the large and mega buyout world. In mega buyout, you have like maybe 10 players in the world who can buy very large companies. So here, just to be there, you need to be an expert and to have the resources. And usually the players there, they buy blocks, but even then there is high competition, which doesn't necessarily exist in the mega buyout world, because the alternative for the seller is securitization. If you're GIC or Temasek or one of these large sovereign wealth funds, instead of selling on the secondary market and basically eliminate some of the goodwill you've been patiently and very expensively building, if you need cash, you might use it as a collateral to get a loan, basically. So even there, you know, you have less competition. You might think, you know, when the seller comes to the market, they're desperate, I'm going to have a very nice ride. That's not totally true. The market has been structuring very fast, and that's probably one of the most innovative corner of the market, the secondary market. Then you have the mid-market. It's extremely competitive. You have a lot of players there. There is, of course, the fund of funds. It's been documented that they're the buyers of last resort. They're extremely professional. Usually they build their information system because they have access to the primary market. And so the secondary is basically building on the information which is patiently built on the primary analysis. The deadlines are extremely strict. And as it's written here, you have a lot of alternatives now, to the point that the fund managers themselves somehow are competing with you as a secondary buyer. The GP-led restructuring is basically a way to bypass the secondary market by offering an exit to LPs who want to get out, and LPs who want to stay can, and others can get out. So the GP-led restructuring is actually somehow on this market biting into the size of the potential market. And then you have the small or below the radar, and also there is an increasing competition. The reason for that is that, of course, some of the people who used to be on the mid-market are a little bit more of a taker of smaller end, and so it used to be that it was a very local market, and now it starts to be intermediated. The fourth one, which I didn't write here, is all the unusual stuff, so niche, emerging markets, etc. And here the competition tends to be lower. It's more of an expert play. But actually the key question is, why do the sellers sell? And I think that's a very, very important question, because on the secondary market, then you can start to assess what are the dynamics if you try to look into that. So what could be the reasons? The first one, of course, is financial distress. But the thing is that you have so many alternatives today. I used to work at UBS, and I was in charge of private market research at the Chief Investment Office. And I was talking to clients, and they were mostly high net worth and family offices. And they said, you know what, we can get a Lombard loan today and use our portfolio of funds as a collateral. It's not great, but actually, if I really, really need money, I think we can find a solution. Of course, you might say the current environment, which is fairly stressed, maybe Lombards might be too expensive, or maybe, you know, the collateral will be used in an inefficient way. But it used to be that if you had a portfolio worth 10 million, you could get at least 5 at a very decent interest rate. And that's very, very small, 10 million portfolio. And still you can get a Lombard. So the financial distress, of course, you could assume that there might be, and pension funds which suffer from imbalances in their asset allocation might come to the market, etc. But remember, you have all these alternatives here, including preferred equity, staple financing, securitization. So it's possible that you don't have to sell, even though you have a cash constraint, a payout, or something equivalent. The second is regulations. I will go fast. It's less and less relevant, but here, usually you have some time and you don't do it last minute. So if the price is not right, you don't transact. Portfolio rebalancing, that's what we're focusing on now. But exposure management can be actually handled in the sense that you don't necessarily have to go to the secondary market. You can, for example, rebalance progressively. What we learned from the last crisis is that now investors have brackets of exposure. They also have different ways of rebalancing. They can isolate their private market exposure and only look at the liquid, what they call the liquid part, in isolation, and rebalance between stock and bonds without touching their private market exposure. So they learned a lot from the previous crisis. I think it's below the radar because it looks so nitty-gritty and operational focus, but actually investors learn very valuable lessons from the previous crisis. So are they going to resort to the secondary market? That's possible, but not necessarily systematically. And actually what we might see is a lot of what I would call spring cleaning. So, you know, there is this sentence in American politics which say, never let a good crisis go to waste. Here, you have a very good, you know, COVID-19 to blame for whatever problem you have in your portfolio and to do some cleaning up. You don't like a fund manager, you don't like an exposure, COVID-19 is hurting you, so you have to get rid of it. And I think we're going to see that. But then, that's this case here. You lost trust in a fund manager, and you won't tell, of course, the potential buyer, and the intermediary is not supposed to know, and you won't tell him anyway. But that's why, as a potential buyer in the secondary market, you have to be very, very careful. I saw some portfolio come by recently, and I was like, it's not crisis related. It's just that what's inside the portfolio is very, very unusual and probably very difficult to price. And the last bit is the funds reaching end of the life. But here again, the GP-led was notably recently probably pumping all the deal flow there. So probably the portfolio rebalancing is still going to provide some sort of deal flow, but the question is, what's going to be the price? And is it what you want to buy as a potential buyer? Because earlier we said, oh, that's a good way to diversify, to complement your exposure, etc. But you don't know. Maybe it's something that you already have a lot in your portfolio, and maybe it doesn't make sense to add another relationship, to make all this effort, to double down and maybe dilute your good performance with a new fund manager, which might not be so great, because remember, your discount on NAV is not that great anyway. So the question is, how do you investigate that? And the only ones who can really act are the ones which are constantly on the market. And that's where I think the secondary market is very demanding. You have to be in the market all the time. You have to network, you have to hear the rumors, you have to basically get this permanent inflow of informal messages, sort the noise from the signal, and then be able to act when the secondary opportunity comes. So it's not to say you shouldn't do it, but what you should be able to do is to say, why do I get this offer? What's the context? And does it make sense to do this type of investment? So what I usually explain to clients that if you want to enter the secondaries, you need training, not from me, but you need some training in the sense that before doing a deal, you shouldn't rush. You should look at a lot of them and start to get a sense of how does it work? Do you have the confidence to make a proper offer? Do you know, for example, if there is use of a credit line, what's the actual exposure? What are your liabilities? What is actually in the portfolio? Because of course, the realizations continue to happen even when you're doing the due diligence on the fund stake. So this is the kind of thing which is very important. It's, in a way, it's running like a 100-meter race at the Olympics, not necessarily the final, but even in the preliminary selection, you still need to have a good training, because you're going to compete with people who are professionally trained and do that all the time, right? So that's what I try to list here. I already mentioned a lot of that, so I will go faster. I think it's nice to have graphs. So now I will have a series of graphs that I would like to introduce. And this is about performance. If you look at the performance of secondaries, it's around 15.3% over the very long term. And that's a simple average. It's not capital weighted. And if you compare that with fund of funds, which are my proxy for an index of private market, as we saw before the break, it's around 10%, slightly below actually. So it's a no-brainer. You should do secondaries, right? The problem is that it's measured as an IRR. And since the duration of secondary funds is fairly low versus fund of funds, which are probably the longest duration investments, then of course the IRR is skewed towards secondaries. And that's probably where my client make a little bit of a mistake, because if you compare IRRs and the durations are not standardized, then of course you end up with a very skewed analysis in favor of shorter durations. So IRRs are time sensitive, and then we have all the biases associated with IRRs. And on top of that, some secondary fund managers actually use leverage, but you might not be able to do that. If you're an Ardian and you do a stake of 500 million, then you could use leverage because it's almost a collateralized portfolio. But if you do small acquisitions on the secondary market, you don't use leverage, so your IRR won't be magnified as such. So it's also very important to know what you're comparing and with what. But nevertheless, if you look at my graph here, so these dots here represent vintage years. So they are not funds, but vintage years, okay? And I took a sample for fund of funds and secondary funds. So it's almost a no-brainer. You should do secondaries. But now let's have a look at the cash on cash. This is much more telling, right? So if you look at cash on cash, you see that, first of all, there is a direct relationship between the distributed versus the distributed spread. So top and bottom quartile, I calculate the spread. This is your fund manager selection risk. I plot it here, and then I look at what your expected DPI if you dig into that. And you see that actually the R square is not so great, but there is some form of correlation. It's a bit scattered around, and you have these trend lines, right? So you might say, but now you're telling us that the distributed is the same than the IR, basically. It's not totally true, but nevertheless. Yes, but what we have to look is apple to apple. So we have to look at funds which have experienced the same conditions, which is what we did on the next slide. And the next slide, now you see the vintage years. And what we did is that we matched secondary funds with fund of funds with 3, 4, 5, 6, 7 years lag. So when you take a fund of fund of 2000, we matched it with 2003 for secondaries, 2004 for secondaries, 2005 for secondaries, etc. And what happened, I just took a snapshot with the average 5, because when I talked to intermediaries like Green Hill, they said the average maturity of a fund on the secondary market is around 5 years. So that's the graph I put for you here. But this graph doesn't change if you do it with 3 or 7. And what's very interesting is that you see that first, actually, the fund of funds outperform. And I'm not selling you any fund of fund. I don't invest in fund of funds and I don't do products. So it's just purely research. But the fund of funds actually perform better than funds, secondary funds. The thing is that secondary funds can do, of course, lower returns, but also higher. But if you look at the dispersion of risk, it's also correlated. And so the ultimate message is that it's not that fund of funds always outperform. That's not the case in 2008 and 9 and 2000, for example. That's below even the trend line of secondaries. But if you look at the majority of fund of funds, they tend to do better than the secondary funds. Why? Well, because when you do secondaries, you leave money on the table. You know, if you buy with a 5 years maturity, some of the best deals have been exited already. And actually, the best deals tend to be exited fairly fast. These are the superstars of the portfolio. The fund manager gets a great offer. You sell after 3 to 4 years. So if you wait 5 years, you end up with a pre-built portfolio, yes. You end up with still very interesting asset, yes. You end up with maybe a discount, yes. But the thing is that some of the assets which are in portfolio might not be the best ones. And so you gave up some of the performance and you traded it for faster liquidity. That's the actual conclusion. Now, what are the pairs where the secondaries actually outperform the fund of funds? That's when you take a fund of fund of 2000 and a secondary fund of 2005. Actually, it's 94% exposure. The discount is 6% here. And when you have a fund of 2003 and you bought it with a secondary fund in 2008, you have the 30% discount. And that's where you actually outperform. So you can look at it here. So 2008, that's here for the secondary, and 2003, it's here for the fund of fund. So you see that the performance is slightly higher, but on a risk-adjusted basis, if you take this into account, 2008, you were better off investing in secondaries here, okay? So the discount is actually nice to have because we also match the discounts and try to look at if there is a correlation between the volume of discount and the actual outperformance of secondaries versus fund of funds, and that actually it's irrelevant. So the discount is not the make or break. So that's actually reassuring when you're in a very low discount environment as we have today. It's actually reassuring because it shows that what matters is really what's in the portfolio, okay? So the conclusion of that, and I think I'm on time, yes, more or less, so that's perfect. We caught up a little bit with my delay. The first thing which is very important is that we should get out of the notion of illiquidity or liquidity premium, because this analysis on the secondaries shows us that actually the secondary market is a very complementary market to the primary market, and it's purely an opportunistic one. So there is no illiquidity risk. It's a matter of duration. And what is the average duration? And of course, you can have a variation of around this average duration, and that's actually your risk. But saying that on average, you stay 2.5 to 3 years with a secondary fund, whereas with a fund of fund, it's around 5 years. It's not an additional risk on the fund of fund side. It's just a different exposure. It's also good because if we ditch the notion of illiquidity risk, we have to ditch the notion of illiquidity premium, which is something which I'm fighting regularly with clients, because for them, private market is listed plus, and it's not true. It doesn't work like that. So if you start to eliminate all of that, then you can start to think about, okay, the duration is my third dimension of investment. And when we start to have this conversation, then you have this three-dimensional axis, right? So you have here X, Y, and Z, Z being my fund. And Z is actually your duration target, right? So if you're a pension fund in the coal industry with a lot of retirees, the coal industry not recruiting anyone and being basically an industry which is tailing off, the third dimension for you is very important. The secondary market might be the best if you really want to get an exposure, because you need strong payouts which are fairly predictable and coming rather fast. If you're a pension fund for young executives in the IT industry where they're not going to retire before the next 10 to 15 or even 20 years, the Z axis should be very long. So you don't necessarily need secondaries, because secondaries are good when you need shorter exposure, faster access to cash flow, and then of course you need to have this predictability. But if you're here for the long haul, you don't necessarily need it. Does it mean that you should never use it? No, of course. Of course, if you have a nice opportunity, if you get access to, for the good reason. So what could be the reason to use the secondaries? I eliminated the slide. You want to get a very specific exposure, which you didn't have before, and you screen the market, you get the opportunity. Second, you want to go into a niche. You're not comfortable to go as a primary investor. You want to know what you're buying. That might be a good opportunity. You get a very, very good deal because the seller is really in a rush. The portfolio has not been marketed. There is a nice discount. The assets are very in your knowledge base, then maybe. Or you have a strategic perspective. There are some assets in the fund that you want to monitor. You're ready to buy that because it's a vantage point, maybe. But beyond that, after that, you need to have a really serious allocation policy with a specific allocation dedicated to secondaries. And actually, I will conclude on that before giving you the word for the Q&A. If you look at two of the asset allocation models, some of them use secondaries with a 0 to 10, for example, and that's really a pure opportunistic part. Some others would say there is buyout, VC, growth, or whatever, and then there is secondaries, and they have like a very specific allocation to that. And it's not purely opportunistic anymore. It becomes a vehicle which is used for a specific purpose. And as I said, especially if you have a very strong base of very old retirees, then that might become a part of your standard asset allocation. Do you have any question?
Yes, I do, Cyril. Two remarks, and maybe when you plot the risk return profile of fund of funds versus secondary, what do the dots represent? A specific fund name or
no, vintage year?
No, I know, but within the vintage year, any fund of that vintage year from any?
Correct. Yeah. Because, so any fund of 2001, which is captured by Cambridge, is in there. Yeah.
Because what I don't like in private equity, in particular, is to average things out. As you know, return dispersion between a good manager and a bad one is huge. So is it fair? Is it fair to amalgamate everybody in the same bucket? Is it a representative sample?
So yeah, that's a
right manager is key in your allocation.
Yeah, of course. That's a little bit the limit of the exercise, because the risk measured here is the spread between the top quartile and the bottom quartile. So when you see 0.8 here, it means that for 2007, the fund of fund, the DPI, for example, maybe the bottom quartile was at 1 and the top quartile was at 1.8. So that's how we measure the risk. But you're right, it's not perfect, and it's a work in progress. We never found any way to put in one figure the whole risk associated with private market investing. So I agree with you. What you will observe is that somehow there is a strong correlation between distributions and the DPI spread. So even though it's not perfect, at least it gives you a very good hint about the risk associated with fund manager selection. And the DPI is capital weighted. So it's as if you could buy the market of the fund of fund in 2001 and by the market of secondary funds in 2005. So it's really by the dollars, if you wish, and it's not the number of fund managers. So it's not a median or a simple average, it's capital weighted. But yeah, it's far from being perfect. I agree with you. There is always ways to improve. The thing is that so far, I didn't find any better way to put it. So it's the best tool that I have so far.
No, it's better than nothing, of course. And speaking of which, we invest in secondaries because of the J curve, and because of the cash on cash return. So the IRR, there is a slide on the IRR, and then the fact that it's a little bit twisted in this case. Does it really matter? I mean, in theory, we are multiple cash multiple focused investors, but so long term, that's why you can do tech and really low liquidity stuff. But doesn't secondaries fit in the bucket where you get a faster return of your cash and therefore your return can be a bit lower?
So it's actually what you describe is exactly what I try to advocate to my clients. You have to look at your payout. So if you have like the kids of the beneficiary owner reaching within the next 3 years, let's say the university age or the business school age, and you have some sort of payout to plan, maybe you should think about secondaries now. If they're 5 or 6 years old and they don't really want to buy a Porsche in the next, let's say 3 years, then maybe you can shoot for less liquid strategies, which might generate more absolute performance. Having said that, the venture industry is a challenging one because it's even more skewed in terms of performance, and the IRR spread, the performance spread cash on cash is very, very high. So I would say, if you combine buyout and secondaries, then you can probably optimize your exposure to match the distribution from your funds with your payout schedule, okay?
Okay, thank you.
In the same context, Cyril, you've done this extensive research. Are there any structural differences between geographies in this world when it comes to your analysis?
Unfortunately, that's the limit of my knowledge. It's extremely challenging. With the data we get, which is high quality, but not very granular, I couldn't dig into, for example, fund of funds which are focused on for example, developed market versus emerging market, and secondary even less. To the point that in secondaries, you might even have not only private equity, but sometimes even private real assets. So you might have in this fund some sort of real estate exposure or something. It's tricky. And that's one of the frustrating part of my job, is that you know that some of the stuff you capture is not purely clean and you have to deal with it. So I cannot answer that, unfortunately.
And the last question, I'm not sure you could answer that one, but as a GP myself, I'm obviously exposed sometimes to secondaries. But the GP-led restructuring, is that something that you see on the rise right now? And if so, what are the circumstances, or what's driving this?
So yes, we see more and more of that. It tends to be for fairly large funds with very established fund managers. I didn't see so many at the lower end or the more emerging part of the fund manager side. At the beginning, I thought it was a scam, to be honest. I thought, clients, you should never do that, right? And then I thought, okay, before saying anything like that, let's have a look. And then if you start to speak with the fund investors, so my clients, they would say, but that's great. That's great. Actually, I think it's the best alternative, because it said to the following: I have the chance to get out if I want or not. Most of the time, I don't want to get out. Whatever happens, if the fund manager ends up with 4 to 5 very good assets in year 7 or 8, is going to want to reset his hurdle or change some terms because he wants to remain motivated, right? So in any case, it would happen. Now, if I want the cash, I get the option and I don't get the discount I would get that if I have to go on the secondary market. Plus on top of that, I have to pay the intermediary, which shouldn't be forgotten, right? And so I transact at NAV. And so, you know, it's either I stay and the economics gets reset anyway, or I get out at NAV. So for them, in that respect, they say, actually, I'm not particularly upset. I'm not happy. If I could avoid it and we go to year 10, 11, and 12, or we finish everything by year 10, we would be much more happy. But the fact is that this fund was affected by this or that factor, and they would anyway play this game. So actually they say they know the assets. Often there is very limited, just a budget or limited management fees. The side fund or the fund B, whatever we want to call it, has no investment period. It's immediate, so it's only the divestment going forward. And there might be some sort of elements where they reinvest some of their carried into the new structure. So the alignment of interests might be actually still very good. So I was very surprised to hear that. For the fund manager, I understand why they do it, but for the fund investors, I realized actually there are some elements we need to keep in mind, and it's not necessarily unfavorable.
Pardon, vas-y. Well, you make me think of something. Cyril, you must have come across 17 Capital.
Yes.
But I mean, the GP-led, I think, is color specialty, and they're very good at it. And they say it's 40% of their transactions. But 17 Capital are now raising their 5th fund, and the first fund was 80 million, and now it's 1.8 billion. This is crazy. So this is another type of GP-led secondary in a way, right? It's more preferred equity. Or have you started analyzing this emerging asset class?
The problem is the data. So it's there are plenty of things I would really love to do, but unfortunately, I barely get anything. And the problem is that if you focus only on one manager, it's very difficult to generalize the findings. So my best hope is that sooner or later, the database providers will start to split what they call the special situation bucket into subcategories, and they start to isolate them. But if history is of any, let's say, help, they tend to do it going forward, but not necessarily to integrate past strategies. The other thing is that sometimes special sits are very, very opportunistic. And so even if they try to do that, because I don't want to throw the stone at the database provider, they might have a hard time to do it. To be honest, it's a recurring issue that I face. If you look at, for example, Europe, which is a very, very interesting topic, there are some funds which are global and invest significantly in Europe, but you don't capture them in the European statistics very easily. So it's going to be like that regularly. So to answer your question more straightforwardly, I would dream about having data, but at the moment it's not available.
That's what makes our industry so interesting, that we're not.
Yes, that's the positive spin.
For sure, I leave. Thank you. Sorry.
No problem. So we're due to make another quick break. We can do it, or we can jump into it and finish earlier, as you wish.
Let's carry on, no? Unless anybody
is tired. Okay, let's do that.
I was just thinking there's something that has to keep the blood boiling in our industry, right? I mean, it's got to be.
That's why you're still in it and you can't retire anytime soon.
That's why I'm in VC, which is why we're constantly like in volatile blood scenarios anyway.
So the next one is co-investments. It used to be the hot topic. I would get a lot of questions on that, and recently it was a little bit less frequent. So, but nevertheless, it's one of the few tactical instruments that we have. So that's why we decided with Stefan and Raja that it would be a good idea to put it here. So co-investments. Why would client ask questions about it? I think a lot of clients got scared about the number of fund manager relationships that they have to handle, and the fact that they get more and more questions about it. And actually, probably the one who is the most emblematic is, of course, CalPERS. It seems that CalPERS is like a piñata, right? Everybody loves to strike them. And sometimes I put myself in their shoes. I'm like, that's probably not very nice, because they're so big, they have very, very limited resources, and they have all these fund manager relationships. So when I think that was the Wall Street Journal, which published a paper saying they don't even know how much fees they pay, I was thinking, it's logical. I mean, it's so much work just to track what's going to happen and where do you stand, and to, you know, to comply with your guidelines, that tracking the extra stuff, it's just an extra cost, and you don't necessarily have the resources. So a lot of clients decided to reduce the number of relationships. And that's how, for example, some fund managers decided to launch a kind of branding initiative where under one umbrella, you would have your relationship manager, and they would offer you complimentary, excuse me, there's some pollens in the garden.
And now you try to not scare us. Now, thank God you're away.
In any case, you don't risk anything. It doesn't go through the internet. Yeah, that's where the fund managers have been so innovative, and they said, you can have with us buyout, you can have infra, you can have real estate, etc. And you have one person, and then we can even make you special conditions. Now, the problem when you reduce the number of relationships, it means that for the amount of assets that you have to a swollen allocation per fund. And funds are limiting the amount that you can have in each given fund. It's usually around 15 to 20% max. Sometimes it's even as low as 10. So if you reduce the number of relationships, either you invest in mega buyout funds, because these are the ones with 20, 25, or even 30 billion of size. But if you want to do venture, the guys are going to tell you, look, I'm sorry, but maybe a large fund in venture would be 500 million, which is already quite big. And then if you compute, let's say 10% of that, and you're a CalPERS, 50 million is too small. You want to deploy 100, 150 million. So it means that your portfolio is going to end up very skewed. The alternative to that is that you max out your capacity in this 500 million, and then you make a side commitment from your co-investment pocket, right? So that's part of the logic. Some others might say, we want to be able to overexpose ourselves to some industries, we want to control our exposure, we want to deploy capital faster, we want to reduce costs. We will see that it's not that simple, but that might be an argument. So co-investments are supposed to be cheaper. I didn't say free, because that doesn't exist, but cheaper. And so there is a kind of rationale behind that. And of course, some of the investors have also strategic perspective. We talked a lot about pension funds so far, but you have a lot of corporations investing in funds, and they want to have a vantage point on specific industries. And then the co-investment might be a way to get the foot in the door to ultimately get access to the purchase of the company itself, right? So this is a little bit let's say the rationale behind. So why do fund managers accept it? Because somehow they shoot themselves in the feet, because basically this is money they don't control. So they reduce their carried interest and their management fees, because co-investments are supposed to be fairly immune from this kind of cost. The first thing is that, well, if you want to sign a large investor, it's either or nothing. So either you give them access to co-investments or nothing. The second thing is that it might reduce your workload, less side letters, and on top of it, it's either this or they might want to negotiate your fees. So the headline fees might not be changed. And if you're, for example, an investor which reaches the 10 to 15 to 20% threshold in the fund, then you get access to the specific conditions where you're allowed to co-invest. And by the way, it doesn't break the rule of equality between your LPs. because you can perfectly say, if it's explicit and documented, that to get access to specific features, you need to be committed at a certain level, right? So that's one way to put it. The other way is that if you remember before the last crisis, the SEC started to look into club deals. And club deals were very much in fashion because you would buy very large assets and you couldn't really buy it out of your own fund. So you would invite your friendly competitors and then together you would buy a company. The SEC said, we're going to open investigations because it is anti-competitive, okay? So if you're into that and you still want to buy these very large assets and you don't have the fund to do that, then the logic is not to team up with your competitors anymore because you don't want to have the SEC investigate you. What you do is that you invite your LPs, right? So the co-investment replaces the club deal, and the SEC theoretically doesn't have anything to say. Actually, we will see in a moment that the SEC still has something to say, and it created a lot of problems. So what are the risks? First of all, if the fund invests you when they don't have enough cash, it's because maybe that's not their sweet spot. Normally, the fund is dimensioned based on the number of deals with an average transaction size, and that's their sweet spot. And they don't need you to do that. They don't need you, let's be honest. It's not because they are nice that they invite you as an LP. You know, there is no such thing as nice in private equity. It's a very, very competitive environment. The people doing that are extremely smart, but they also want to make money and to maximize it. So if they invite you, it's because either you bring something to the table, which is not money, because money is a commodity. It's because of your expertise, because they want to flatter you, because you're a very large investor and they want to you to invest in their future funds. Okay, so they make a short-term sacrifice on some management fee, but if you commit, for example, 10 to 15% or 20% in the next generation of funds, they recoup that, and notably in terms of marketing and commercialization, etc. So they save a lot of hassle. But besides that, if they invite you, it's probably also because it's not their sweet spot. So you might have what we call in academic terms a lemon effect. So you end up with the deals, which are not bad, otherwise they wouldn't do it. You know, track record is something that they want to preserve, of course, but they might do a deal and it might not be the greatest. And so because they're a little bit out of their comfort zone, then they say, okay, let's team up with the LP anyway. We wanted to co-invest, let's do the deal. That's the last one in the fund. We're going to trigger the 70% to raise the next one, etc. So it's been documented by the academic literature that there is a bit of gaming here. The second thing, which is very risky, is liabilities. And here I have 3 very concrete cases that I want to explain to you. I won't spend too much time, but just to illustrate that. And liability, I think, is widely underestimated by LPs. And I think, to be honest, that the current environment is going to be a moment of truth. And actually, I always highlighted that even when I was at the bank, for clients, telling them you have deep pockets. When a company is going into bankruptcy, the judge is going to look and then he or she will find the deep pockets and you might be on the hook if you're directly exposed. The fund protects you. If you're a co-investor, it's your pocket. You might make a blocker, whatever, but ultimately it's you. So be aware of it. And so the liabilities might be reputational. I will give you an example of that, which has been very, very serious. It might be financial, but it might be also liabilities like the pension liabilities in the US with the ERISA system. So I will have 3 examples very briefly. And the last one is, of course, concentration risk. Yeah, the thing about the fund is it's a diversification play, right? So if you reduce the number of relationships and then you co-invest, it means that you double down by construction. It's funny because a lot of clients don't really remember that. For them, it's like, oh yeah, we deployed more capital, we're happy. Yeah, but if there is a blow up, it's going to show more. It's going to show more. So it's not that easy, you know, to deploy capital and at the same time keep your diversification. Especially if you're not invited systematically, because the lemon effect implicitly assumes that you get invited when there is spare capacity. it's very unusual that you get invited systematically in all the deals. You have to negotiate special rights for that. And then you have to act on it. I mean, if it's vacation time, if it's Christmas, if it's an industry you're not comfortable, then maybe you will have unbalanced portfolio. And I think it's very important. The last thing I wanted to highlight here, just for the sake of disclosure, is that so far academic studies concluded that co-investments are doing at best as good as funds. There is no outperformance. And it's very, very interesting to see that, because there is an ongoing debate about why is it like this. And we don't really know yet. But especially the guys from Harvard were probably some of the best, if not the best, in the academic field, with the guys from Chicago. They really concluded in a way which is very, very careful about the fact that there is no outperformance. So what are the perceptions and reality? Just like I did for the secondary, I will try to illustrate in a very practical way. So if you talk to fund investors, they think about cherry picking. So I will get this very nice deal flow, which is pre-analyzed, which will come to me. I won't pay anything out of it. And if I like it, I just pick it up and I put my money. And then there is no work. In any case, the fund manager will do it for me. They will do the monitoring. So it's fine. And I save money, right? The fund manager thing, that's a pool of capital. I will have to babysit and handhold a bit. And if I need this extra capital, I have it. So somehow that's how I'm going to use it. The thing is that I need to make sure that the agenda of the LP is going to be exactly the same than me, so that I remain in control. So co-investment is not co-lead, no. It's not even a partnership of equivalent. There is a pilot and you're in the sidecar and that's it, okay? So it's really, the reality is really that you're following and you have very short time frame to make a decision. You're not doing your due diligence. You might get a call, maybe. You get maybe the due diligence pack, maybe, but you have to make your decision fast, within 2 to 4 weeks max. And you're not here to redo or renegotiate or add stuff. It's take it or leave it. I think that's also very important. So the limits are really, really strong, and it's really far from cherry picking. The other thing which is very important to notice, as I wrote here, is that actually the SEC, interestingly enough, started to investigate. The problem of the SEC is the following. You have investor A, who is a simple investor in the fund, okay? And you have investor B, who is an investor in the fund and has co-investment rights. The SEC said investor B is actually treated differently than A. Why? Because when you as a fund manager, you analyze a deal. If the deal doesn't go through, you charge the cost to the fund. So A and B will pay. But B will pay only for the portion that he or she invested in the fund. Whereas when the deal is done, A paid for the cost, B paid for the cost pro rata to the fund and the cost for doing the deals. So B, in a way, is treated in a favorable way, because if there is a deal which is aborted, the aborted costs are only charged to the fund and not to the co-investor. And the SEC said, that's not fair, it's forbidden. So the new practice now is to say a side pocket, which is called a co-investment fund, where you have management fees and carried interest and all of that, and say, okay, you're B, you cannot really, because SEC said it's not proper, you cannot invest alone. So we're going to put you in a fund with reduced fees, and you get access to that because you put a large amount in the main fund, we charge the full fees, right? But of course that defies the whole construct, because you don't want to end up in another fund. You don't want to end up paying fees, etc. So there is still an ongoing debate about that, and I think it's not finished. Interestingly enough, it's the SEC which is really forward on that. The ESMA in Europe didn't really look into that, but it's a fairly new initiative, and we're probably still getting a grasp of our industry. So what are the other elements? So I said less fees. Actually, so there is the problem of sharing the cost, and then there is other problems. For example, if you look at statistics of performance on co-investments, usually they say, oh, well, That's how we communicate it, but they don't take into account, for example, the monitoring cost. They don't take into account the structuring cost. So there are a lot of costs which are basically charged to the organization which is co-investing, which are escaping. And it's very important. I will show you statistics from CalPERS later. It's very difficult for them to extract how many hours of lawyers they used internally to work on this co-investment. How many hours of staff member is used to monitor this specific deal. They don't do that. It's too complicated. Already they don't know how much fees they pay to the fund managers. So imagine tracking the cost in-house and doing basically a budgetary accounting for task by task. It's beyond what they do. The other thing which is very interesting is that actually some tax-exempt investors in the US started to have a problem because they get income when they get to sit on the board of the deals they have been co-investing. And this is actually what we call unrelated business taxable income. And if you get that, you might lose your tax-exempt status. So now you start to have all these other very interesting things where you get money and you don't want it because it might have an impact on your tax-exempt status. Of course, that's very specific, but just to illustrate the scale of the issues that you might get from co-investment. I don't want to scare anyone doing it, of course, but it's just also to be realistic about what does it mean. It's not that easy and straightforward. So let's have a quick look of the different cases. So I took 3, which are widely documented, and you can document further if you want. So I have these 3. The last one, which I couldn't really illustrate because I don't have the details, is that when you do co-investment, you get more pressure from your beneficiary owners. We saw that with the endowments in the US, which invest in oil and gas. Their students have been demonstrating and putting a lot of pressure, but also some pensioners or beneficiary owners at large, which have been pressuring their institutions not to do certain deals. The great thing about when you're an investor in a fund, as I will show you in a second, is that you are at arm's length. So you can try to ask the fund manager to do something, but they have a fiduciary duty to you, but also the others. So that takes off some heat from you. But if you're, for example, a Canadian pension fund and you invest in a specific company and then something happens, then you will be under pressure. And that actually might hurt you financially. So it's also important to keep this in mind. But as I said here, I don't have a clear example. So let's jump into the 3 very tiny business cases. I'm conscious of the time. We should finish on time and have enough time for the Q&A. I wanted to make it more concrete because now we are reaching 1 hour 45, and so be less theoretical. The first case is a reputational concern. So Cerberus, a very large fund manager in the US, decided in 2006 to acquire almost the full control of Freedom Group. Freedom Group makes weapons. They own Remington, and a few other very famous brands for handguns, but also semi-automatic guns. And then basically they started to do a buy and build. So it was a buyout, and then they bought Outdoors. How was it called, this company? Outdoors something. And then Remington was the initial brand, and they renamed it as Freedom Group. In 2009, they wanted to do an IPO, but it was basically withdrawn due to the conditions. And then later the gun sales started to basically drop significantly, notably due to a certain number of new regulations. In 2012, they did a dividend recap. And basically at the end of the year, there was this dramatic shooting in an elementary school. And the shooter used a Freedom Group gun, which is called a Bushmaster. So 28 people were killed. And apparently some of the, let's say, the people who unfortunately passed away were actually future pensioners of CalSTRS. CalSTRS being the largest Californian pension fund, actually the largest in the world, for teachers, professors, etc. So they invested 750 million in the Cerberus fund. And it means that indirectly they controlled 2.4% of the Freedom Group. And of course, the pensioners started to say, well, we shouldn't be at all invested in this company. This company is doing things which are hurting us. So they made a motion, and basically the board of CalSTRS made an explicit request to Cerberus to say, you should sell the company or we should get out. Okay, so on 18th of December, Cerberus put Freedom Group for sale, and there was no buyer. It was a hot asset. I don't know if you remember, but it made the headlines for more than 2 weeks. I mean, this shooting was really, really a shock. I mean, of course, we know why. I mean, but it was a very, very big topic in the US. They had shootings, but this one I think was particularly terrible. And so on the 8th of January 2013, actually CalSTRS said, we're going to exclude firearms altogether from all our portfolio. And so they went to Cerberus, and Cerberus said, well, that's nice, but technically we don't know how to do it. There is no one to buy it, and we don't want to liquidate it to sell it for $1. We have a fiduciary duty towards the other investors in the Cerberus fund. And so what they did ultimately is they created a side fund where they transferred the ones who didn't want to be investors in Freedom Group, and basically that was the Fund B. And it took them 1.5 years to do that. It was so complicated, especially because nobody could put a price on Freedom Group. And then what happened is that the people who stayed in the Fund A actually ended up with a loss, because there was another school shooting, this one in Florida, which was even worse. And ultimately, the company went into bankruptcy and was handed over to creditors. So it's not a typical case of co-investment, but it illustrates what would have happened if CalSTRS would have been an investor in Freedom Group. That would have been a disaster. Because, of course, if you want to sell Freedom Group, here, I think Cerberus did the minimum requested from them to try to sell it. But even if you were an investor, basically a minority investor besides Cerberus in Freedom Group, you wouldn't have been able to sell. And imagine the amount of pressure from the pensioners on the board, on the executives, and of course on the investment managers at CalSTRS. I think that's very important, because here it's very obvious. I took it as a business case because it's weaponry, but there are many, many cases where it's more borderline, and when you do the investment, it sounds fairly logical, and then you realize later that it was not a good idea. And so I think that's fairly illustrative of the reputational concern. The next case is even more scary. And once again, I'm not here to tell you not to do co-investment, but just to illustrate the extent of what does it mean. Sun Capital bought in 2006 in a distressed environment, a company which is called Scott Brass Incorporated, and they decided to restructure it. Distressed debt investment is very, very challenging, and unfortunately didn't work out. So SBI filed for a second bankruptcy, and they were actually liquidated at the end of 2008. Now, the interesting thing is that the pension fund of the people working for Scott Brass, and namely the ones in charge of the transportation of these copper strips and all of that, decided to basically claim the pension in the proceedings of the bankruptcy. And of course, the problem is that Scott Brass probably didn't have the assets to pay for that. So TPF, so the pension fund, decided to sue Sun Capital. And then, of course, the guys at Sun said, well, you know, it's not us. I mean, we're just a fund manager. The fund cannot be sued. It's not an entity. It's just a fund. So we're the fund manager. We're an agent. The fund, the principal is not liable. So you cannot sue us. And normally, you would say they're going to win, because basically the whole industry is structured like this, right? Now, the interesting thing, as you can see here, is that in 2013, the US Court of Appeal said that Sun Capital had a direct economic relationship. And so basically that it was in control of the business. And so it's liable. There is an explicit business relationship. It was a shock. And it was even more of a shock when the federal level in Massachusetts, 3 years later, confirmed there is a typo here, buy, it's B-Y, not buy, like buying. It was confirmed by the Federal District Court. And so now I think they're going to wait until it goes to the next step. But the lawyers are saying, if it's confirmed, that might change dramatically the industry. First of all, we might have a massive drop in distressed debt. But my take is that it also means that when you will have a blow up in an LBO like Toys R Us, if you co-invested with the Bain and all the others and KKR, I think it was in Toys R Us, then you know, if the pension fund of the Toys R Us employee says there is a liability here, you have to pay, it's not going to be only the two fund managers who will be liable, but you as a co-investor. So that might change dramatically the industry. And here you're a deep-pocketed investor. And as I said, the courts always go for the deep pocket to pay out the most immediate and pressing liabilities. So here, it's extremely important. I think, of course, it's limited to the US at the moment, but depending on how it's handled in the next level of appeal, I think it's an appeal, then we're going to see the industry probably change dramatically. Just for the small story, labor laws are extremely important. For example, the boom of the private equity industry is born out of a change in the ERISA, the prudent man rule of interpreting how pension fund managers should invest. And it's based on the portfolio, and that's how they could invest in private market. But you can see that it has a very, very large reach, and it can create some joint liabilities. And nobody would have thought about it. You would think about corporate law. Here, it's labor law. It's a very, very powerful source of changes in the industry. The last case, which is probably also very interesting, is the case of the Sovereign Wealth Fund of Norway and Formula One. This one is a little bit lighter than school shootings or people losing their job and their pension happily. So the Sovereign Wealth Fund of Norway is forbidden to invest in private markets. It was confirmed actually 2 years ago. And the reason for that is probably this business case. So the GPFG manages the money of Norway in the oil industry. And they were invited by CVC, which bought Formula One, in a pre-IPO case. So on May 22nd, the GPFG bought 4% of Formula One, and the IPO should have happened 7 days later on the Singaporean stock exchange. So in a way, there is a gray area here. It's not really allowed, but it's not completely forbidden because it's pre-IPO. So pre-IPO, there is IPO, so you could say it's almost liquid. So it could have been almost admitted for the GPFG to invest there, knowing that once it's listed, they would invest in it anyway, because as we know, they own, I think, 1 or 2% of all the stocks worldwide. The other thing which is very important is that the GPFG is supposed to be ESG compliant. It's one of the few sovereign wealth funds which makes a very, very explicit effort to invest according to ESG criteria. It's also managed by the Norwegian Central Bank, which responds in front of the parliament of how it manages the pension fund. And for the little story, the recent stimulus of 68 billion of the Norwegian economy, which was decided 2 days ago, the money comes from this fund, okay? So the IPO is withdrawn due to market condition. And now comes the terrible part for the Central Bank of Norway. First of all, on February the following year, the judge finds that the CEO of the Formula One, a very colorful character named Bernie Ecclestone, paid bribes in a certain context. And so he had to pay a fine of 44 million. Now imagine the riot. The Sovereign Wealth Fund invested in a company that is not allowed to invest in, that it is not allowed to invest in. And on top of that, the fund manager is dragged into a very, very unusual case of malpractice, and with a very, very colorful character in front of the British tabloids, which has been convicted Okay, so in terms of ESG credentials, that's already very bad. And then later, Ecclestone had to settle charges also of corruption, this time in Munich. So it's to add insult to injury. He was convicted in another jurisdiction and they couldn't change him. That's the thing. So the CEO was probably not ESG compliant, but the GPFG, which is in effect a co-investor with CVC, had nothing to say. And so there were grilling sessions where basically the GPFG manager had to admit in front of the parliament that this was a mistake, that they didn't want to be, but actually they had no choice because it was an illiquid company and they couldn't get out. And they had no board seat. There was nothing they could do. It's very, very interesting. And so it's just a typical illustration of the reputational damage of the sovereign wealth fund in such a co-investment. And how bad can it be? It's sports, it's Formula One, it's glamorous, and it turns out that it can be very, very bad. Now, for the little story, the Formula One was not IPO'd. It was ultimately sold to Liberty Media for 8 billion. And at the time, Ecclestone was still the chairman. The funny thing is that the GPFG refuses to communicate on the performance on that. So it's very difficult to know if they made money at all, but my educated guess is that if 2 years ago, the central bank refused against the advice of the scholars who wrote the study, namely Stromberg and Doskeland, the two scholars from the Stockholm School of Business recommended that the GPFG invest in private market because they saturated their listed world. The central bank decided to go against it, and they listed multiple reasons which didn't make any sense. The only reason they didn't list is actually because of a reputational concern, and I think that's the real reason, and that's this case. That's basically bad memory, and they said no, we shouldn't go there because it's a recipe for a lot of problems. So I have a few stats. As I said, it used to be all the rage, so I did not have to look again at that, but I wanted to provide you with some elements about co-investments and what did happen over the long term. The first thing I wanted to show you is the performance of CalPERS as a direct and co-investor versus fund investor, and you see that actually the performance is not particularly different in terms of multiple of invested capital. You could argue maybe CalPERS is not the best direct or co-investor. Maybe, but still, I think it's a representative one. It's not small amounts, it's 2.7 billion. And you see that they're doing slightly better in terms of IRR, and the multiple of invested capital is equivalent. And that's gross of fees for the co-investment, whereas funds, it's after fees and carried interest. In terms of co-investment, it is estimated last year that there were around 55 to 60 billion done. Now, it was all the rage in the media, but what I wanted to show you is that it's not a new phenomenon. Actually, when I started 20 years ago in venture, there was a lot of co-investment already. What we know is that it's pro-cyclical. How do we see it? It's with this graph here. You see that the fund investments and the co-investments tend to be fairly correlated. It's not one-to-one, but it's fairly clear. The other thing which is very interesting is that in terms of company count, it doesn't show that much. But if you look at, let's say, the channel, so let's say the funds, you see that the correlation is much clearer. It's not one-to-one, but it's fairly clear. So what does it mean? It means that first, it's pro-cyclical, but also it's skewed towards larger deals. Co-investments usually happen in deals which are fairly stable. Mostly in the buyout world. It used to be venture in 2000, 2001, but now it's mostly growth and buyout. And these are easy to understand assets and fairly large. Why is it fairly large? Remember, you tend to get invited when it's not the sweet spot of the fund manager. So it's usually when they need to syndicate to buy it because they need more money. How do we know that? Because when you look at the co-investments, which are the darker shades here, they're systematically bigger on the average capital invested than the average size of the fund deals. And it's also true in the post-money valuation if you look at venture. The only exception is is somehow LATAM, but it's probably because at that time we didn't have a lot of stats on LATAM, so it's very challenging. The other thing which is very clear is that it's higher ownership, and that's logical if you think about buyout. You can have minority buyouts, you can have buyouts where the threshold of ownership is around 60%. Here, if you look, you will see that almost systematically, except in Middle East, but there might be some regulations involved here, the co-investment threshold of ownership is much higher than for the funds, okay? So it means that usually it's larger assets, it's pro-cyclical, and it's with control. The other thing that I wanted to show you is that ultimately, if you really want to sum it up, it's co-investments from developed markets to developed markets. So there is a lot of home bias. And that's why I'm very, very careful when I have clients who do co-investments, because they tend to pile on what they know. So if it's a family office, I have a few like this, they usually come from an industry in a specific region, and they tend to co-invest in an industry that they tend to know. So if it's biopharma, they would do a lot of direct biopharma deals in their region. And if you want to do portfolio construction around that, that makes your life extremely challenging, because you have always to overweight the rest and to counterbalance this exposure. But it's fairly logical. If you want to do a proper co-investment, you need the expertise, and you go back to your roots. So we have another family office in construction industry, and they tend to be in this value chain. But the problem is, of course, that you don't necessarily want this exposure anymore, because the core holdings, the anchor of your portfolio is already there. So you don't necessarily want to double down. What you want for the future generations is to diversify out of that. And that's where the co-investment starts to be very challenging, because otherwise then you need to pay a lot of resources to have co-investment activities in industries where you're not very familiar. So this expertise is very expensive. And that's why historically we created funds with fund managers which have the expertise, and the cost is split between investors, etc. So the conclusion of this is that you can do co-investment, but it's like, you know, I'm French, partially French, and it's like the Tour de France. Tour de France, if you want to win the Tour de France, you're doing direct investments. You're the best in your league. You're going to compete with your peers. You're trained. You do this all the time. Co-investment is being on the team. You know, it's not sitting in the car or in the bus or watching it on TV. No. Co-investing, if you want to do it properly, you have to be able to almost sit on the seat of the winner, but you have to be able to sit at least on his team. Now, commenting is like managed account. So when people ask you, do you want to co-invest? But you know, you have like a host of advisors doing it. Supporting is fund investing, and watching it on TV is being the beneficiary owner, if you wish. And I think this image is not far off of where does the co-investment sit. You might say, maybe commenting could be a bit of co-investment, but then you need to practice every weekend and know what does it mean to be training, and you know the strategies and all of that, because otherwise you're going to lose your edge. This is it. I tried to stick, oops, I'm 5 minutes above. I'm still available for Q&A. I don't know if you have questions.
Very interesting, Cyril. Hans-Jürgen here again.
Thank you.
I'm priming Raja now with the first question for the last session. Very interesting analysis, and certainly for me as a venture capital manager, I'm probably not as exposed to direct investment, co-investment, sorry, as private equity guys are, but I still am. And I think a lot of the elements that you mentioned here are confirming simply what we're telling our LPs is don't do it as a general rule. My question would be, in your experience and given your clients, and I'm assuming they're both institutional and probably family office, oriented, do you see a trend there between those two large, let's say, buckets in terms of their attitude, given all the findings that you've given towards co-investments? E.g., are family offices still more excited about it than, for example, CalPERS or institutionals, pension funds?
It comes from the top. So in that sense, when the decision is taken, I think there are two buckets here. There is the institutions, and then there is the family office / high net worth individuals. When pension funds decided to go down that route, to change the strategy, you have to go back to the board and they have to rewrite their allocation policy or their investment strategy policy. So the thing is that there is a little bit more, paradoxically, there is a little bit more freedom, because the investment manager could always say, we didn't find exactly the right opportunity that we wanted. So we ended up doing nothing, or just 1 or 2 deals, but actually what we saw was not convincing enough. In the family office / high net worth individual world, the beneficiary owner can be very, very present. And here it's a different environment. The pressure is there. Usually you have to find the right answer, which is strongly suggested.
They of all people usually be pretty receptive to the argument of, for example, liability exposure, because it's them personally, right?
True. It also depends, I would say, on the profile. I mean, if it's the first or second generation, they're very risk prone. They know a lot. Sometimes not as much as they think they do, but they tend to think like that. And then it's very challenging it's very challenging to tell them not to do it, because they have the arguments to do it, but it's even more challenging to manage the risk. And so in that context, I would say that's the limit of the role of the advisor, to be totally honest. The pensions also tend to do more stable assets. Family offices, it really depends. Sometimes they're very much into early or even seed stage. Others are a little bit more conservative, especially if you reach the 3rd, 4th, 5th generation or beyond, then it's a little bit more stable assets. It's like they have cash flow generative assets, fairly stable, and then they want to buy it. And usually they use the co-investment as a way to secure it. So in that sense, it's not illogical. So they team up with the fund manager, they set up a kind of plan in the shareholder agreement where they say within 3 to 5 years, we might have an option, and we already set up, for example, the way we could buy it so we don't fight in 5 years. There is a formula. And then they use the, let's say, the fund manager to secure the asset, to test the management, to set up the processes so that they end up with a plain vanilla asset, which is, you know, at the top, and then they just keep on going.
Yeah. Last element, maybe correct me if I'm wrong, but whenever I hear this argument about reduction of fees, you touched upon it. I mean, obviously, what LPs typically think first is management fees. They would sort of save. Now, there's the argument, first of all, that they would have to, as you said yourself, in order to be trained and to be on top of the game, they have to invest themselves into infrastructure that will cost, and it'll be a cost no matter what.
Yep.
Whereas, and this is always our argument towards LPs, and I just wanted to test it, at least in the European context, the fund structures are such that the management fee, if you're a successful manager, it'll be paid back as part of the commitment anyway in the first place. So if you're successful, which is the assumption, it's actually 0 fees for the money that you invest into the fund. It may be different in the US because sometimes they have this commitment plus arrangements when it comes to fees. But is that about right? I see you nodding. So
yeah, I agree with you. It's a difficult case to do because there is a bit of strong opinions on the question of fees. So as someone in research and advisory, I tend to avoid this kind of debate because also it depends. It's a little bit, as you said, fund manager by fund manager. And some investors have very strong opinions, and it's like the debate on tobacco. The pros and cons will never agree on anything, so I don't want to get involved in that. But to a certain extent,
got it.
You know, the reason why you get a net performance, which is attractive, means that you've been able to recoup the costs. So, and the fund is a good way to split the costs. I mean, instead of paying a full lawyer,
Risk, yeah.
pay a portion of lawyer with your co-investors in the fund. So there is still some logic and economies of scale there. More questions?
Thank you.
Thank you. I had a conclusion, but we're above time, so I won't cover it. It was just a wrap up. I just put it because it's recorded in case you want to review the slides. And it was a summary of basically what we said, and in particular to highlight what are the conclusions on the secondary co-investment and how do you pull that into a portfolio, and to a little bit of warning against the behavioral biases of investors, which are mentioned here. Sometimes we're our own worst enemy because we tend to reproduce what we think is correct, but it's not necessarily always true. So this was the main conclusion.
Thanks a lot, Cyril. Thanks for your questions, the audience. Before we close this first e-training, I wanted to give you a quick overview on the next sessions to be organized by the LPEA. Indeed, we intend to schedule a separate and dedicated training with Hedda Paulsen on impact investing ESG, which are quite important and growing topics. Next to that, we are also preparing with our team a summer academy with different modules, including a PE foundation course with, guess who? Cyril, happy to host you again. A module focusing on private equity risk management, one on venture capital, and last but not least, a module on sustainable finance. We'll keep you posted concerning the next steps and dates. And dear LPEA members and friends, thanks again for your presence, time, and trust. Thanks, Cyril, for sharing your expertise with us, and hear from you soon.